Can't get anybody to get excited about this at all. Boy, have times changed, Surratt. I told you that Buffett endorsed your ownership of Bank of America. He's been buying it for 12 straight days, and I guess so. No one seems to be excited about it.
What is up, guys? Welcome back to the channel. In the summer of 2020, financial companies were really hurt, and analysts were only bullish on a few names in the sector. Despite the concerns, Warren Buffett was making moves on Bank of America and kept buying the stock consistently. Let's hear what these CNBC analysts had to say about it back then.
Well, Scott, he could buy it for another 12 days. He can't really fix the headwinds that are challenging the money center banks. You know that I'm in JP Morgan. That's the one bank that I think is the best in breed. As it relates to Bank of America, the reasoning behind why I am not in that is just the significant consumer exposure that it has and the absence of trading revenue that you will find in some of the other financials like a Morgan Stanley, a Goldman Sachs, and even JP Morgan, which reported a strong quarter. So, no, I wouldn't suggest if you're going to be picking one of the money center banks that I would buy Bank of America. If you're buying Bank of America right here, you might as well just go buy Wells Fargo, because I think you'll probably have more upside return if there is an environment where the banks, all boats seem to rise. So I think you have to stay best in breed, which takes me to JP Morgan. And if we're going to the thesis that all banks are going to rise, well, then you go Wells Fargo.
Warren Buffett is known for being incredibly patient and for sitting on trades that might not work for a while. So I think if that's how you're feeling, then it might not be a bad time to start nibbling. But I don't think we're really going to see any real traction in this group until we start to see more of an economic recovery scenario playing out that involves interest rates moving higher. We kind of got a couple of weeks ago a little bit of a reality check when we saw how much many of these banks had started building their reserves. So they definitely are exposed in many ways to the economy and to the consumer in some ways. We own JP Morgan. That is also our only holding in this space. So we haven't completely abandoned the group, but just think that we are not yet prepared to start adding more exposure here, given what we think is going to potentially be a longer-term time horizon before we really see a recovery.
So the general consensus was that there are a lot of headwinds for the big banks, and such trade would pay off if even in the really long term. But there is this famous quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." So he saw the potential and kept on buying the stock for Bank of America. Fast forward 9 months and the stock is trading 60% higher than it was back in August of 2020. So Buffett was right to be buying at that time. But is Bank of America still a good buy right now, or could there be better opportunities elsewhere? We will try to answer that. So for the comparison today, we have Bank of America, ticker symbol BAC, Wells Fargo, WFC, and Citigroup, ticker C. In order to make the comparison possible, we will be looking into 8 different factors: analysts' price targets, price to book ratio, annual revenue growth, price to sales ratio, return on equity, last 4 quarterly earnings results, cash per share, and dividend yield. The best component and each factor will get a point, so it is possible to have from 0 to 8 points. And in the end, the stock with the most points will be considered the winner of this comparison. I hope that the rules were clear, so let's begin. First factor we have are the analysts' price targets. As investors, we are interested to find how far the current share price is away from the average target of analysts. If the current price is under the average target, we will consider the stock as undervalued, and in the end, the company with share prices furthest away from the average target to the lower side gets a point for this factor. For Bank of America, we have 22 price targets of analysts. They range from the lows of $35 to the highs of $50 per share. The average is at $42.95, and the current share price is at $41.62. So there is around 3.2% room for the current price to reach the average target of analysts. For Wells Fargo, we have 21 price target of analysts. They range from the lows of $40 to the highs of $65 per share. The average is at $47.95. And the current share price is at $45.84. So there is still around 4.6% room for the current price to reach the average target of analysts. For Citigroup, we have 22 price targets of analysts. They range from the lows of $66 to the highs of $118 per share. The average is at $84.84, and the current share price is at $75.68. So there is around 12.1% room for the current price to reach the average target of analysts. Results for the analysts' price targets factor are in the table, and with the highest percentage, Citigroup gets the first point. Second factor is the price to book ratio. It is calculated by taking the share price and dividing it by the book value per share. The formula suggests to be looking for a company with a low market cap and a high book value. So in the end, the stock with the lowest price to book ratio gets a point for this factor. For Bank of America, the price to book ratio is at 1.43. Price to book for Wells Fargo is at 1.14. And Citigroup has a price to book of 0.86. Price to book ratios are in the table, and with the lowest value, Citigroup gets another point. Third factor is the annual revenue growth. As investors, we want to find that the revenues of a company are on a steady increase. We will take a look into the four most recent years and compare them one by one. If revenue was on the increase from one year to the next, we will consider it as a +1, and if it was on the decrease, it will be a +0. Then we sum the results up to a minimum of 0 and a maximum of 3, and in the end, the stock with the highest sum gets a point for this factor. Annual revenues for Bank of America, and going into 2018 there was an increase to $87 billion US, then into 2019 we had a decrease to $85 billion, and going into 2020 there was another decrease to $74 billion. So with one increase and two decreases in annual revenues, we have a sum of 1. Revenues for Wells Fargo, and going into 2018 there was a decrease to $84 billion US, then into 2019 we had another decrease to $82 billion, and going into 2020 there was a decrease to $58 billion. So with 3 decreases in annual revenues, we have a sum of 0. Annual revenues for Citigroup, and going into 2018 there was an increase to $65.5 billion US, then into 2019 we again had an increase to $66 billion, and going into 2020 there was a decrease to $58 billion. So with 2 increases and 1 decrease in annual revenues, we have a sum of 2. Results for the annual revenue growth factor are in the table, and with a sum of 2, Citigroup gets another point. Fourth factor is the price to sales ratio. It is calculated by taking the market cap and dividing it by the trailing 12 months worth of sales. The formula suggests to be looking for a company with a low market cap and a high result in sales. So in the end, the stock with the lowest price to sales ratio gets a point for this factor. For Bank of America, the price to sales is at 4.41. Price to sales for Wells Fargo is at 2.97. And Citigroup has a price to sales of 2.41. Price to sales ratios are in the table, and with the lowest value, Citigroup gets yet another point. Fifth factor is return on equity. It is calculated by taking the net income and dividing it by the shareholders' equity. A high ROE shows that the company is well managed and that money from investors are efficiently handled. So in the end, the stock with the highest return on equity percentage gets a point for this factor. For Bank of America, the return on equity is at 8.14%. Return on equity for Wells Fargo is at 4.24%, and Citigroup has a return on equity of 8.35%. Return on equity percentages are in the table, and with the highest value, Citigroup gets 1 more point. Sixth factor are the last 4 quarterly earnings results. When a company reports earnings, they are compared to expectations of analysts. So earnings can either beat expectations, meet them, or miss them. We will consider that beating expectations is a +1, meeting +0.5, and missing 0. Then we sum the results up to a minimum of 0 and a maximum of 4, and in the end, the stock with the highest sum gets a point for this factor. We have quarterly earnings for Bank of America, and Q2 of 2020 beat expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 4 beats in quarterly earnings, we have a sum of 4. Earnings for Wells Fargo, and Q2 of 2020 missed expectations, Q3 missed, Q4 beat expectations, and Q1 of 2021 beat. So with 2 beats and 2 misses in quarterly earnings, we have a sum of 2. Earnings for Citigroup, and Q2 of 2020 beat expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 4 beats in quarterly earnings, we again have a sum of 4. The results for the last 4 quarterly earnings factor are in the table, and with sums of 4, both Bank of America and Citigroup each gets a point. Seventh factor is the cash per share ratio. It is calculated by taking the total amount of cash available and divided by the shares outstanding. The ratio shows the company's ability to reinvest and expand, or to otherwise buy back shares or pay dividends to investors. So in the end, the highest cash per share gets a point for this factor. For Bank of America, the cash per share is at $93.75. Cash per share for Wells Fargo is at $117.26. And Citigroup has a cash per share at $476.29. Cash per share results are in the table, and with the highest value, Citigroup gets another point. The last factor is the dividend yield. It is calculated by taking the annual dividend per share and dividing it by the share price. A high dividend yield may suggest that profits are shared with shareholders, and that is a great passive income source that we as investors are looking for. So in the end, the stock with the highest dividend yield gets a point for this factor. Bank of America is currently paying an annual dividend of 72 cents per share, which is a yield of 1.71%. Annual dividend for Wells Fargo is at 40 cents per share, and that is a yield of 0.85%. And Citigroup is paying an annual dividend of $2.04 per share, which is a dividend yield of 2.66%. Dividend yields are in the table, and with the highest percentage, Citigroup gets one more point. We can calculate the results, so Bank of America has 1 point, Wells Fargo 0, and Citigroup 8. I don't remember another time when it was so one-sided, but with a sum of 8 points, Citigroup is considered the winner of this comparison. And that was it. If you got value or new ideas, then make sure to push that thumbs up, it helps the channel a lot. Now there's a question for you: have you recently been buying or selling any of the bank stocks? Share your moves in a comment below. If you are interested to know exactly when I buy or sell in a stock, then consider the options on Patreon. Last week I did a comparison on several cybersecurity companies, and we have 38 weeks worth of investing with the Revolut stock portfolio. If you are interested in any of those, then click on a video currently on the screen. And that was it from my side. Thank you for watching, and I will be seeing y'all in the next one.